Let's go live now to the Bank of Canada Governor Tiff Macklem. He's answering questions on interest rates and Canada's economy.
Governor, how
Paul, can I just ask you to turn the mic on, please? Thanks.
Governor, how it appears from the statement in today's speech that you are intent on bringing down inflation and bringing in higher interest rates. What would have to happen? How bad would the economic fallout from the conflict in Ukraine, how bad would that have to get for you to stop, put a pause on this, given your concerns about higher inflation?
These hypothetical questions are always a little bit hard to answer. Look, what I would say is, first of all, the Canadian economy is strong. You saw fourth quarter growth earlier this week, 6.7%. The flash estimate for the first quarter and a range of other indicators suggest that the first quarter is going to be stronger than we expected in our January monetary policy report. And the restrictions, Omicron is fading, the public health restrictions are easing. We do see solid momentum in the economy. Our direct trade ties with Russia and the Ukraine are both very limited. Look, there's no question this is a major new source of uncertainty. It's having immediate effects on commodity prices. We're seeing financial market volatility. I think you can expect some effects on confidence. I think you can expect some new supply chain shipping disruptions. Those will weigh on growth. We will need to factor those in as we take decisions. And we'll really be looking at how those are impacting the Canadian economy, and we will be importantly looking at our outlook for our inflation forecast and our views on how inflation is coming back to target and what is needed to make sure that happens as we take those decisions.
Thank you. We'll go to Mark Rendell of the Globe and Mail next, please. Mark.
Thanks, Governor. Great to be here in person. On Ukraine and the potential impacts of that, we've seen commodity prices going higher, energy's going up, grain prices, all of that. That's going to put, as you say, upward pressure on inflation, but it also has the potential to benefit Canadian energy producers, agricultural producers, all of that. How do you balance, I guess, when you see a commodity price spike like this, how do you balance the negative aspects of the impact on inflation against the positive aspects on GDP, trade, and economic output for those commodity producers?
Short answer is carefully. As you indicated, Canadians are going to see the impact of the higher commodity prices fairly quickly. When I came this morning on my screen, oil prices were about $110. If they were to stay there, that would add about a percentage point to inflation. That's just the direct impact through energy. There will, if there are other commodity prices, wheat prices, for example, are higher, so you can expect something in food. And higher energy prices mean higher transportation costs for goods. So, look, these prices are bouncing around. They're very volatile. I'm not gonna give you a new forecast, but it's pretty clear that our near-term inflation outlook is now higher, and Canadians are going to feel that in their pocketbook. They're going to feel that very quickly when they go to fill up their cars, when they go to the grocery store. So it is going to have an impact on the purchasing power of Canadians. As you indicated, the other side of it is that we are big exporters of many of these goods. Oil, obviously, wheat, potash, nickel. The global prices of these are now higher. That is a positive terms of trade shock for Canada, as economists call it. Basically what it means is for every unit we export, we're getting more income now. These things are worth more in global markets. That will bring more income into the Canadian economy. Again, we'll have to see where these prices go from here, and what the implications are, I mean, we're just now into the second week of this unprovoked invasion. The other thing you need to factor in, and gets a bit back to Paul's question, is, there will be other consequences of this invasion. There will be effects on confidence. We're seeing a lot of volatility in financial markets. So, we're going to have to weigh off all those factors as we assess the implications for the Canadian economy and monetary policy going forward. And, as I said to Paul, I think the two key things we'll be looking at are the evolution of the Canadian economy and our forecast for inflation.
Okay, we're going to go to Julie Gordon of Reuters now, please. Julie.
Hi, Governor. Nice to see you again. You said earlier that you were not ruling out a 50 basis point hike. I was wondering if you could maybe just elaborate a bit for us on what you'd need to see in order to actually go ahead with a 50 basis point hike.
Another hypothetical question. But look, yesterday we took an important decision. We've had our policy rate at its floor for almost 2 years now. Yesterday we took it off that floor. We raised interest rates by 25 basis points to 0.5%. And we signaled very clearly that we expect our policy rate will need to rise further. Interest rates will be on a rising path. So, how quickly we move interest rates up on that rising path, or how slowly we move them up on that rising path, is going to depend on the evolution of the Canadian economy and our outlook for inflation. Inflation is well above our target, and there are upside risks, and we are. Given that we're starting well above our target, we are more concerned about those upside risks. And so if we feel that we need to move more quickly, we need to be more forceful, we're prepared to do that. And so I'm not going to rule out a 50 basis point move in the future if we felt it was necessary to move more quickly.
Bon, alors passons maintenant à Anne-Caroline Desplanques du Journal de Montréal.
From Anne-Caroline Desplanques from Journal de Montréal.
Bonjour, gouverneur. Merci pour les questions.
Thanks for the questions, Governor. Mr. Governor, what are the risks that the Bank of Canada could be a target of a cyber attack in the context of the war in Europe? What would be that's a question of a cyber attack? Yep, okay, thank you. Yes, everybody must be very vigilant and very careful. There's always the risk. There's always a risk of a cyber attack. And yes, now the risk is higher, especially for the financial system. It's very important that everybody looks into this very closely, these risks, and ready. We have an understanding, a strategic understanding for cyber attacks at the Bank of Canada. It's always important to always improve our strategy, because the possibilities of attacks are the attacks have become more sophisticated, more complex, and very, very important that we improve constantly our strategy. But I'm confident in our strategy. But yes, we must be ready for all sorts of possibilities. And also, concerning the financial system, the financial institutions in Canada have some cyber attacks strategies, very sophisticated. They did a lot of investments. We work with them, and I know that they are aware that there's an additional risk now, and that they're following this up very closely.
Thank you. We're going to turn now to Eric Hertzberg from Bloomberg, please.
Afternoon, Governor. I'd like to ask you about your guidance on quantitative tightening. When you say that you'll stop purchasing bonds, will that happen all at once at the beginning or in a more tapered fashion? And how will that impact your primary bond purchases as well?
Okay, well, before I get to these sort of very specific issues, let me just say a few things. Previously, what we had said is that we would remain in the reinvestment phase until we increased our policy rate. Yesterday, we increased our policy rate. And in our deliberations, we reconfirmed that having raised our policy rate, QT is a logical next step. And so today I did outline how we intend to implement QT and what do we think it would do. And this really follows our very deliberate strategy as we, before we make a change, we outline how we intend to do it and what we think the impacts will be. Monetary policy works better when people understand it, and it's really important that we get out ahead and outline how it will work. So in terms of the specific questions you asked, the intention, I think the base intention would be to move to move to roll off. So what that would mean is that we would stop buying Government of Canada bonds. We would stop replacing the bonds that are maturing, which is what we're doing now. And so that our balance sheet, our holdings of Government of Canada bonds would shrink. Our holdings are all on our website. Everybody can see them, so it'll be completely transparent, predictable. And with respect to primary market, so look, I think the presumption would be that we will let everything roll off. We have some operational decisions to take at the time when we actually decide to do this. I'm not going to nail down all the details, but certainly no secondary market purchases. And I think the presumption should be full roll-off. And we will need to consider whether, for operational reasons, we want to have a little bit in the primary. But those are, I would say, technical decisions. You would see considerable roll-off.
Okay, we're going to go now to Jordan Press from the Canadian Press, please.
Good afternoon, Governor. In your speech, you said that if history has shown us anything about waiting too long, about raising rates, it could actually become more costly. But you also noted that raising rates is going to cause a bit of a double whammy for some households, from higher borrowing costs, but also elevated inflation. So I'm wondering, what is the alternative scenario then that you mentioned where it could become more costly? Can you explain it to those households who are facing that double whammy? What would be the worst case scenario if you did not start raising rates today?
So what happens if inflation expectations do become unmoored? And what we saw, we lived through this in the 1970s. And what you see in an economy when inflation expectations become unmoored is that nothing in the economy works well. Inflation becomes, what did we see in the 70s? Everybody felt like they were getting ripped off because, they'd get their paycheck, but prices would go up. There was a lot of strikes. There was a lot of labor strife because workers always felt like their wages weren't keeping up with inflation. What we've learned from history is that the economy just does not work well when inflation expectations become unmoored, and that's why it's really critical that you keep them moored. In the current context, we have these big supply disruptions that are boosting inflation. And as the pandemic eases, those supply disruptions should gradually work their way out. Provided we keep inflation expectations well anchored, as those things work out, inflation should come down. But if we let inflation expectations become unmoored, then when those supply constraints ease, inflation won't come back down, and it'll be much more costly to get it back down. So that really, I think, outlines why that is critical part of our thinking going forward.
And we have time for one last question. We'll go back to the phones for David Parkinson of the Globe and Mail. Thank you.
You know what, Governor, you already answered my question. Thanks very much for anticipating what I was going to ask. So you're off the hook. That's forward-looking central banking right there. That's what that is. Okay, in that case, we'll call it to a close. Thanks very much, Governor Macklem, and thanks to the reporters both here in the room and those who dialed in. Thanks to all of you for watching and listening.